Okay, hi everyone. This one's going to be a little bit more fun because this is the first time I've done this question. So, and the other thing as well is that I put the webcam on, so you can see me too. I've written out over here, so if you can see, look at the left-hand side. Also, the question's in the right-hand corner, kind of over there. Can't do any. Bottom right-hand corner is where the question is. We've got cash in on the left. Cash flow statement. So we've got cash in, cash out, cash in minus cash out will give you the net cash flow. Add that to the opening balance, closing balance. And then we've got the profit and loss statement or the income statement, again in this format. So we've got revenue, cost of sales, revenue minus cost of sales gives you the gross profit. Then we've got all the operating expenses. We expect to have quite a few of those, so just set this up like this. Gross profit minus total expenses will give you the EBIT, earnings before interest and tax. Less interest gives you the profit before tax, PBT. Less tax gives you the PAT, profit after tax, or the profit for the year, operating profit as well. And then you can do less dividends, will give you the retained profits. The retained profits will go into equity on the statement of financial position, as will any share capital over here. Also, the closing balance of the cash flow will go into current assets under cash. So let's have a look at the question, and I'll probably end up getting it wrong. So we'll have a look and we'll see if it all balances. And again, the whole point of this is to try and when you go through every point on the in the question, every single statement. So we've got 13 statements here. We cover everything, so we're not going to go through it twice. Okay. So let's have a look. I'm going to write in blue, I think, for this one, just to make it a little bit clearer. Now, okay, so if we look at number one, and I really hope that it's not too small that you can see it. So we've got construction of very simple financial statements. Follow Up Limited, fake company, year one, transactions in summary. So number one, issued shares and obtained £100 from shareholders as capital. This is the initial equity invested by the shareholders. So we're even given the clue that that's equity, but we should know that. Okay, so issued shares and obtained £100 from shareholders as capital. So cash in over here, we're going to have £100, and that's going to be shares, okay? And that's going to be equity, okay? So we can write here share capital, £100 from shareholders as capital, okay. And that's number one. We never have to worry about number one again, hopefully, if we've done everything right, okay? Number two, obtained a bank loan of £50 and received the cash. So bank loan of £50, receive the cash, so we can cash in £50, bank loan £50, receive the cash. Bank loan is a non-current liability. Bank loan £50, because we don't expect to pay that within the same year. So if we did, that would be current liability. All right. Now, what you could ask is that, yeah, well, we're also building up these assets, and well, we are, and the reason thing, and the other thing as well, obviously we know that the assets have to equal liabilities and equities. So if we're building up equity over here, and we're building up liabilities in the non-current liability section, why aren't the assets increasing? And the answer is they will, because remember that our cash in is increasing, and when we have our closing balance of cash, that will be transcribed under current assets over here as cash. So it will, and it should balance. So that's number two, obtained a bank loan £50 and received the cash. £50 bank loan, increasing our non-current liabilities of £50. Good. Number three, purchased equipment for £50 cash to be used for 5 years. Purchased equipment for £50 for cash, so we've got £50 outgoing on equipment. Equipment will be a non-current asset. Okay, so we can put equipment over here. And I'm tempted to write £50 in over here. Okay, purchase equipment for £50 cash to be used for 5 years. which means that obviously it is assumed that at the end of the 5 years is going to be worth nothing. Assuming straight line depreciation, so that's going to be 50 divided by 5 is 10 pounds a year of depreciation. So at the end of year 1, the equipment net book value will actually be worth £40 because we've incurred a £10 expense on depreciation. So that depreciation expense will go over here as equipment depreciation £10. Okay, so just to read that again, purchase equipment for £50 cash out £50 to be used for 5 years. So that's £10 a year of depreciation. That will go in equipment depreciation, £10. Net book value after 1 year will then be worth £40. Is that correct? I think it is. Okay. Number 4, purchased inventory of tables for resale. So they cost £20 in total and were purchased on credit from suppliers. Purchased inventory of tables for resale. They cost £20 in total and were purchased on credit from suppliers. So that means we've got current liability of £20 for trade payables. Okay, £20. I'm just going to make a little note here as well for number 4. We may have to go back to so you can see that. Note 4, purchased inventory tables, because I think we're going to have to come back to that in terms of working out our cost of sales. Just read that again. Purchased inventory of tables for resale. They cost £20 in total. Purchased on credit from suppliers. We missed something here. Then that means our current assets of inventory will increase to the value of £20. Trade payables, remember we haven't paid for it yet, but our inventory is now at £20. Is that correct? I think it is. Okay. Purchase inventory of tables for resale. They cost £20 in total and were purchased on credit for suppliers. Yeah, okay. Number 5. Sold half of the inventory of tables, which had cost £10, to customers on credit terms for £50. So immediately you've got a revenue here of £50. Sold half of the inventory. So we bought the inventory for £20. If you sold half, then obviously, that's £10 of sales. So the cost of those sales were actually £10 over here, which had cost £10 to customers on credit terms for £50. So we've sold it to £50, but they haven't paid us yet. So we've actually got a current asset of sales receivable. So we can put here sales receivable for £50. That's an asset. Does that match? Yeah, our revenue sold £50, but they need to pay us. Current asset. Our cost of that sale was £10. So I think that is correct as well. Number 6, paid £15 to suppliers of tables and thus still owed them £5 at the end of the year. So that means our trade payables will now be £5 because we paid them 15. If we paid them 15 in cash outflow, trade. Okay, £15 we paid them. And that brings it down that trade payable to £5. our inventory as well. Yeah. So it says this. So when point number 5, we sold half of the inventory of tables, which had to cost £10. So now we've actually only got £10 worth as well. So yeah, you see that's the importance of looking at this carefully. So our inventory went down by £10, and that should have been in point 5. Sold half of the inventory of tables, which had cost £10 to customers on credit terms for 50. Number 6, paid £15 to suppliers of tables. Yeah, we just did that one. Paid £15 to suppliers of tables. Over here on the cash out, still owe them £5 at the end of the year, bringing down our current liability of trade payables to £5. Number 7, received £40 from customers, and thus at the end of the year, customers still owed 10. So our sales receivable goes from 50 to 10 because we actually received £40. Cash in, £40, sales. Okay. Received £40 from customers, and thus at the end of the year, customers still owed 10. Yeah, okay. Number 8, paid £10 for a range of other business expenses, wages, rent, power, and insurance. So we can put that paid £10, £10 go out, put for various. Remember, this is what's accrued, what we actually, what should have happened. We actually paid that £10, so it has gone out. Remember, if we accrue a payment or something, say that we owe, and we pay it, then nothing really should change in this statement of financial position. It's only when we pay something before, i.e. prepayment, that will go as an asset, or if we don't pay something, then that will go as a liability. But if we pay for something that we owe in the right period, we shouldn't be really looking at the statement of financial position, because there's no asset building up and there's no liability building up. So again, just because we had these expenses of £10, paid £10 or a range of other business expenses that came to £10, so we'd put that there, but we paid £10 for it, so cash out immediately, we build up no liability and no asset. Okay, paid £10 for a range of other business expenses, we've done that. Number 9, depreciated the equipment by £10 for the year. Okay, well that was implied by number 3, straight line depreciation. Depreciate the equipment by £10. So we've done that already. Expenses depreciated by £10. Remember, it's not a cash payment, so it won't go on the cash flow. But £10 there, and we've taken that into account by adjusting the net book value of the equipment to £40. Depreciate the equipment by £10 for the year. Okay. Number 10, paid bank loan interest of £5 as required by the bank. So we can put interest here, £5, but we actually paid that £5. So we can put the £5 over here, interest. Okay. Repaid, just read that again just to make sure. Paid bank loan interest £5 as required by the bank. Okay, tax, repay £10. Yes, then repay £10 of the bank loan. So £10 went out, bank loan. Bank loan then would reduce from 50 to 40 if you just paid £10 of that, yeah? Reduces the non-current liability there. Will that affect anything else? No, it shouldn't. Number 12. Tax was calculated as £5 on year 1 profits. Tax bill payable in year 2. Calculated £5. Tax over here. Tax bill payable in year 2. So it's payable, so we can put tax payable. £5. It's payable in year 2, so it's payable within a year. And no dividends were paid. So we'll put dividends 0. So now what we can do is we can, the first thing I would do is do the cash flow, because that's the most straightforward thing to calculate. So let's do that. So we've got 100 plus 50 plus 40. So we'll have 190 over here. Put £190 over here. And then cash out. So we've got 50 plus 15 plus 10 plus 5 plus 10 gives 90. So 190 minus 90 is 100, obviously. So net cash flow, our opening balance was 0 because this is first year. So net cash flow plus opening balance gives you £100 closing balance. So that £100 closing balance can go into our current assets as cash. All right, and then we need to tally the profit and loss statement or the income statement. So our retained profits can go back into equity as reinvested profit. Okay, and now just before we do that, just take a look at the statement of financial position on the assets and just see if there's anything here that will indicate that we need to make an adjustment to the expenses over here. So it's a trick that I learned on the previous one. So if we look at equipment net book value £40, that's because it went down from 50 depreciation. We've taken depreciation into account. Inventory is not an expense. That will go under cost of sales. We've accounted for that. Sales receivable, we've still got £10. Okay, that's not going to go into expenses or anything like that. That's okay. And cash is also okay. So I think that we can add this up. So revenue minus cost of sales, 50 minus 10, 40. Expenses, 10 plus 10, 20. Gross profit minus total expenses, 40 minus 20, gives us an EBIT of 20. Minus the interest, 20 minus 5 gives you 15. 15 profit before tax minus tax, 15 minus 5 gives you 10. No dividends, so reinvested profits should be £10. So we'll put that £10 over here into reinvested profits. Now, hopefully, if we've done this right, the total assets should equal the total liabilities plus total equity. So let's have a look at total assets. So our total assets are 40 plus 10 plus 10 plus 100 gives us, no, that's not right, 4,000, no, 40 plus 10 plus 10 plus 100, £160. Okay, and now let's look at our equity plus total liabilities. So our total liabilities be 5 and 5, that's 10, plus 40, that's 50 for total liabilities. Is that right? Liabilities 40 plus 10, yeah. And our equity is 110. Oh my gosh, it works. So liabilities plus equity gives us £160 equals total assets. So liabilities plus equity, £160 equals £160 total assets. Total assets equal liabilities plus equities. So therefore we've probably done this correct. And I hope that was useful and that you enjoyed it. And if I can, I'll try and do another one. So until the next time, see ya.